from economics education by getting engaged in discussions on pluralist ideas in economics through events and activities. And today's session is one of those dedicated on the topic Neoliberalism's New Poster Child, Revisiting India's Growth Story. Neoliberalism is a restatement of classical liberalism. It typically supports fiscal austerity, deregulation, privatization, free trade, and a reduction in government spending on social programs. In recent times, global investors and institutions have been hyping up the prospects for Indian economic growth in medium term, but there is no solid evidence within India that the service sector and the manufacturing sectors are showing. India has been touted as the home of neoliberal policy regimes largely because the West needed a neoliberal exemplar, and India gave it a size. Its willingness to ally with the US, its hostility to China, and with its commitment to the neoliberal policy that has only intensified, was an obvious candidate. So, can we say that the adoption of neoliberal policy by India is sustainable? We'll explore this issue further as the session proceeds. I'm very delighted to share that for today's session we have Professor C.P. Chandrasekhar as a speaker. He is a retired professor and an eminent personality engaged in teaching and research at Center for Economic Studies and Planning in JNU for more than 30 years. He has also served as senior lecturer, research associate, executive editor. He has also served as a consultant with a host of international organizations such as UNDP, ILO, etc. His areas of interest include the role of finance and industry in development and the experience with fiscal, financial and industrial policy in developing countries. So we are glad to have you here, sir, and keen to hear on the matter. So without much delay, I hand it over to you.
So what's your status? What do you normally do?
Thank you.
Yeah, like
Yeah, 30 minutes, 30 minutes.
Yeah, 30 minutes.
Okay, yeah, so it's unusual to be in JNU and to be given this long introduction, having spent so many years here, but thank you very much for that generous introduction. As you mentioned, what I plan to look at is something I've written a little about in recent times, which is this evidence that, or these signs that India is now being presented in some sense as the significant alternative among lower middle income countries in terms of the potential for development that existed. Now this is important because historically, if you look at it in the period after the Second World War, during the years of decolonization, when many countries were becoming independent, others had already become independent, but post the Great Depression, were thinking of new ways of launching on development under states which wanted to intervene to accelerate the pace of growth and to try and increase productivity in order to be able to raise per capita income and catch up with the advanced countries. And the whole idea was at that point of time that because there are significant barriers to productivity increases in predominantly agricultural economies, and of course the fact that if you happen to be a primary producer, agricultural or mineral primary producer, the structuralists and others had argued you're at the losing end of global trade, both in terms of the pace of growth of demand, which was much more in manufacturing as global per capita incomes went up. And as we know from Engel's law, etc., there's a diversification towards manufacturing. But there's also the fact that the terms of trade over a long period of time, despite some controversy, seem to be moving against primary product exporters. So both from the point of view of the existence, as I said, of these barriers to productivity increase in agriculture, and from the need to be able to actually establish a presence in areas in which you can actually be part of the beneficiaries of trends in global trade, the understanding was that the kind of development these states should adopt in the period after the Second World War should be one which is focused on changing the structure of these economies in the direction of manufacturing. And this was not only in India, this was something, as I said, which was true of most of these countries which were launching on post Second World War development. That was the period of when the whole development discourse, in some sense, emerged in the formal economic literature. Now, even at that point of time, actually India was considered to be a country which had significant potential as compared to other developing countries for multiple reasons. Because if the way in which you wanted to ensure rapid development or be a part of this catch-up with the advanced countries was to diversify in the direction of manufacturing, here was a country which was characterized by a number of features which gave it significant advantages. First, of course, it was a country which, just because of geographical size and its population, meant that even though per capita income was low, India was a poor country if you look at it in terms of per capita income, because of the existence of income inequality and the large size of this population distributed over this large geographical area, it was one of the countries which had a significant domestic market. It already had a domestic market because of the fact of this sheer advantage of geographical size and population. The second was that it was a country which, for almost a century by then, by 1947 or 1951, let us say, for almost a century had been experiencing factory-based production. First successful textile factory in India, successful in the sense that it lasted for a significant period of time, was, according to the economic historians, established around about 1854. So by 1951, you already had a century of factory-based industrialization, an experience with factory-based industrialization. And a significant part of that industrialization was on account of investments undertaken by domestic industrialists. I mean, it was not that much of the industry or the economic activity which the British set up in India, the East India Company, the Crown, the subsequent imperial government, etc., set up, was linked to colonial trade. So it was largely in areas which were linked to colonial trade, and of course facilities needed to foster colonial trades and support the administration, which was the railways, etc. But otherwise, it was in areas like the plantations, like indigo cultivation, like shipping, insurance, etc. So other than for a few industries which were established because of the need to support Britain's imperial interests, like for example, providing guarantees to the Tatas to produce steel because of the fact that you needed some access to steel rather than depend only on imports, particularly in periods of times of war, etc. You saw some degree of support for industrialization on the part of the British, which then took the form of discriminating protection. But as I said, not only did we have this long period of industrialization, but a lot of that industrialization was essentially based on on the basis of investments undertaken by, if you want to call them that, domestic capitalists, those who had entered into the business. So therefore, there was this whole experience, not merely of workers who worked in factory production, but also of industrialists who were engaged in factory production by the time we had got to 1951. And finally, you actually had the advantage of a state which was deeply committed. I mean, the whole Nehruvian ideology and of course subsequently the second plan strategy under Mahalanobis was one which actually emphasized considerably, many argued at the expense of agriculture, emphasized the importance of industry and therefore of raising the share of investment which was allocated to industry in general and to the production of machine tools to actually facilitate industrial production. So you seem to have a set of factors of this kind which actually made India the country which was considered not merely the most industrialized among ex-colonial countries at that point of time, which it was, but also the country which had the most potential in terms of the possibilities of industrialization. But we know that subsequently, if you look at the period since then, not only relative to countries which were not exactly equal to, but close to India in terms of the levels of development at that point of time, countries like Brazil, etc., some Latin American countries, but even countries which at that point of time were far short of India in terms of presence, including South Korea, which was not a country which actually had very much by way of industrialization at that point of time, excepting, of course, for some Japanese investment because it was under Japanese occupation for a long period of time. So despite that, what you actually find that if you look at the period since then, the maximum to which manufacturing, not industry includes electricity, gas, water supply, etc. But if you just take manufacturing alone, the maximum which manufacturing in as a share of total value added or of GDP went up to in India was about 18%, whereas countries saw increases in the share of manufacturing 30%, 35%. In fact, China before the liberalization, by 1978 when the reform was introduced, was close to 40% in terms of the share of manufacturing in value added, in gross total value added. So therefore, we've had one experience in which here was this country which was being seen as the country which is actually potentially the one which would serve as the leader in ensuring some kind of a redressal of the inequality in the international economic order of that point of time because of these characteristics. But if you look at the evidence, it did not happen. Currently, or not currently, but for some time now, maybe for a little less than a decade, let us say, or even let us say since about maybe 2005 or a little later, we see increasingly India being presented as once again being a country which has the most potential. Okay. There are some obvious reasons for it. One, of course, is there was a period when India sustained relatively high rates of growth from about 2003-04 till about 2011-12 or a little more. Subsequently as well, even though growth slowed down, we actually know that India tends to grow, tends to record rates of growth which are higher than most other countries. Of course, higher than the advanced countries, because the more advanced you are, the higher it is to sustain, the more difficult it is to sustain higher rates of growth. But even relative to other countries, you actually find that India's rates of growth are pretty high. And one country with which India is always compared is, of course, China. And for a long period of time, there was no question of comparing India's performance to China, because for a period of something like 4 decades almost, China consistently maintained rates of growth of GDP of something like 8% to 10%, depending upon the base year and the sort of end year, the terminal year that you take. And India hasn't seen that kind of a long period of high growth. But if you look at it in terms of recent times, and particularly the most recent times, the evidence is that India is growing at a faster rate in terms of GDP growth than China is. So you put all of this together, and it is suggested that there is evidence to actually claim that, forgetting of course what was said and not achieved in the past, that in the current context there is potential for this country to actually emerge as some kind of a leader. And this has got hyped up. It's got hyped up quite considerably. You actually have assessments which say that, okay, from a 3.5 trillion economy, which is the fifth largest in the world, India is going to move to being the 4th largest, then very soon it's going to displace even Japan, Germany, etc., and become the 3rd largest after China and the United States. Okay, so first there is this whole idea that there's going to be this economy which, in terms of sheer size, because if you combine size in terms of GDP along with the large geographical space that the country occupies and its large population, it's going to become the most populous country in the world. And if you ignore indicators like per capita income, which of course wouldn't show India up in that kind of positive light, because we know that if you take something like, which is what is taken, a gross national income of something like $10,000 in current prices as being the base level where you seem to be migrating into developed status, which of course South Korea crossed and Taiwan crossed many years back. China is approaching it. It's in the range of about 8,000 US maybe, but India is still stuck in the 3,000 range. So it's a long way to go. But if you don't look at it in terms of per capita, but you look at it in terms of aggregate GDP and look at it in terms of its geographical size and population size, this obviously is going to be a country, it's argued, which is going to be among the top. And in fact, if you take some publications, like for example the editor of Nikkei Asia, and Nikkei owns even the Financial Times now, so it's one of the major financial media outlets in the world, said that actually by the end of 2023, India is going to be very clearly among the top 3 along with China and the United States of countries in the world. So we've been seeing once again a revival of this whole idea that, I mean, here is a country in a completely different context, because that was a context in which you're actually looking at interventionist states trying to put up protectionist barriers with quantitative restrictions and tariffs to grow a domestic market and use that domestic market to grow their economies so that you're independent of your earlier colonial masters. Whereas here now you're saying that in a much more integrated world, pursuing a much more open door policy, you actually have once again a similar kind of argument which suggests that this is a country with the most potential among the lower and middle income countries of emerging as a leader. I mean, if you treat China as being also predominantly a market economy, which possibly it is, then that's the other case that we have. But as I said, China is almost there, in terms of per capita income, and India can approach it. Now, there's one problem, of course, when we have in this environment a similar kind of attempt to try to hype up the Indian experience. And that comes from the fact that we do know, on the basis of experience as far as other countries are concerned, and India as well, that once you had the rise to dominance of global finance, then there is always a need, particularly once you had the rise to dominance of neoliberalism, with long years back, with late 70s, 80s onwards, with Reagan and Thatcher and so on, and then of course the rise of global finance, that you always find the need, because once you have the rise to dominance of global finance with a world which is awash with liquidity, for multiple reasons which I don't want to go into here, then obviously international finance is constantly looking for new targets, for new destinations to lend to and to invest in, and that is what keeps international finance going. And therefore you constantly need to hype up these markets, and therefore we need to be careful. I mean, is this actually, if in the 1950s you said India had the potential to emerge as being a leader among the less developed countries of the world, that was a completely different environment, because you're saying that you're going to have an independent government asserting an independent economic policy which is going to be able to fashion such a change in the international economic order. Now you're talking about an international economic order in which willy-nilly even developed country governments are subordinate to international finance. So you're not really talking about any great independence. But you are talking about the fact that there is no way you could be declared as being, let's say, the future of the third world, if you want to call it, at least in the medium term, unless international finance sees you as that. And there's reason. I mean, if, for example, you see the price earnings ratio, which is the kind of thing which finance likes, because the profits of finance don't really come from the fact that it buys into equity or bonds and gets interest and gets dividend. The profits of finance finally come from capital appreciation. The whole idea is that you should be able to ensure that the financial instruments you hold gain value such that in a very short period of time you can register very high rates of return. So therefore, one of the things everybody looks at are the price earnings ratio. And if you look at the MSCI index, which is the Morgan Stanley index for all emerging markets, and what it says in terms of price relative to trailing earnings for the last 12 months, and look at the figure for India, I mean, you're talking about, I think, if I remember the figure right, I can give it to you exactly in my notes. I think it's as compared to 11.7. You're in the case of the MSCI, you're talking about something like close to 17% in the case of India. Of course, this is before Adani. Adani makes a difference both to the MSCI, and Adani makes a difference to the Sensex, because it features in both, but obviously it has a much more dominant weightage in the Sensex than it has in the MSCI, which is why, but even the MSCI, obviously it had a significant weightage. That's why you want to drop those, or they want to drop those shares. But even, ignoring the fact that, okay, there was this one company which actually was registering this huge increase in market capitalization in a relatively short span of time, which will result in, the price earnings ratio just, because obviously your earnings are not going to be showing the kind of growth that at the value of your stock or your equity is showing. So you would expect India to be influenced by the bias of that one group of companies much more than the other, and that group of companies was not just some Indian company. It made the owner of the stock of that company the third richest person in the world. So you'd expect some difference, but that notwithstanding, that's the way finance looks at it. And if you look at it from the point of view of MSCI, it appears that this hyping up of India as a destination, as the future in this new world of finance, is actually getting reflected in the kind of indices that finance wants. Now, that of course doesn't mean that that country is really strong, okay? And therefore, we need to say that, oh, let's be careful. Is this because of the fact that that India is being hyped up? Because in some sense, at all points of time, there is a tendency. I mentioned, in 1950, but that, in a world of international inequality, which is obviously deeply unjust from the point of view of the interest of nations. I mean, we're not talking about the injustice in terms of inequalities among people, both within a country and across countries. I'm okay. Okay, so we're not talking about inequalities among people, whether within a country or across countries. We're talking about inequality among nations. When there is what seems to be an illegitimate inequality, you actually try to say that, oh, that's because of the fact that countries haven't adopted some set of policies which will actually make them do well. So that at all points of time, you're trying to say, oh, there are these countries which either are doing well or can do well. Okay, so even if we leave the phase out of the import substituting years in the period till the mid-1960s, we know that, at different points of time, first we had South Korea and Taiwan being presented as the miracles which actually point to the fact that there is no real fundamental constraint set by the unequal international order on the possibilities of countries escaping from backwardness. And then some time later, after all, you can't just keep referring to two countries. You began to refer to these second-tier industrializers. So you had, which also interestingly came from Asia. So you had countries like Thailand and Malaysia and Indonesia, etc. To a certain extent, the Philippines, were being pointed to as countries which, listen, they are doing pretty well, and they were at that point of time till the 1997 Southeast Asian financial crisis. So you said that, there are these developing countries which are doing well, and so obviously, if you adopt the kind of policies that they adopt, you also would do well. It's because of the fact that you don't have that, or you don't have a government which is as good. You don't have you're sort of adversely affected by cronyism. There's too much corruption in your countries. Whatever, by maybe the set of reasons. Now the point is, once we went through those two phases. By the time we went through to those two phases, which sort of came to an end in 1997, when actually even one of the first-tier industrializers, which is South Korea, was affected by the financial crisis and never saw the dynamism it saw in the period before the late 1990s. That the question is, where do you move now, and who do you discover? Because Latin America, after the debt crisis and subsequent multiple crises starting in 1982 in Mexico, had seen, at that time 1 decade, but subsequently 2 decades of 2 lost decades, as they are referred to. Africa had seen many lost decades because the kind of ravages it suffered under colonialism was something which was not so easy to get over. It affected its economies in terms of their structure. It affected the politics in those countries, and so on and so forth. So I suppose you had a choice. Can you discover anything else in Asia? And there was a period when there was a certain uncertainty. I mean, when Nixon went to China and so on, there was an uncertainty. You wanted to say that China, which has now embraced markets, which is now become a member of the WTO, which is now integrating with the world system, has become like the good boys were. I mean, or are to a certain extent still, because South Korea was still growing, even if not as fast. But the problem was that this didn't last long, because there was one thing which China was not willing to do, which is to be subordinate to those who actually dominated the international order for multiple reasons. So it was willing to negotiate getting access in return for some degree of access for the West into China, to get access into Western markets and to get access to the world's raw materials, etc. But it was not going to actually be a subordinate player. So and as time went on, as it grew in strength, as it became important a player in the area of technology, in the high-tech industries, as it started getting access to minerals which are considered crucial for the next stage. I mean, whatever industrial revolution 2.3, 2.0, 3.0, 4.0, whatever you want to call it. then obviously, I mean, hostility only increased. So you couldn't use China, so you needed to discover an alternative. And in some sense, part of this hype is not merely because India is being seen as a target for international finance, but it's also possibly the best bet in terms of saying that here is a country which actually can displace China as a player in international value chains and do so while still being subordinate and not hostile to at least the dominant countries, that is the United States and its allies. And of course, one reason it would do that is of course because of the hostility between China and India itself. Okay. So it was one, the fact that you needed a new destination, which provided the basis for some degree of hype. Two, because of the fact that to ensure the legitimacy of the kind of policies and the kind of tendencies which are observed in an international, in an unequal international order, you needed at all points of time to point to those who could be different, could make a difference. India somehow seems to have become the chosen one. Now the point is, there are two difficulties to start with this argument. And the first difficulty is that well, to start with, of course, we know that India's growth success is sort of, coincides with the coming of the new series of national account statistics. In the 2011-2012 national account statistics came, not only did the size of the Indian economy appear larger than what the 2004-5 base statistics of national account statistics suggested, but the rate of growth was higher. And this was not something which some dissenting or radical economists and statisticians were saying. The chief economic advisor under the NDA basically said, Arvind Subramanian said that, listen, I've studied this thing and there's no way, these figures are not okay. That actually the growth rate is exaggerated, might be by 25% to 33%, etc. So we are not really, we're not even really talking about a set of statistics which even within what would be the mainstream or let's say offshoots of the establishment is considered to be an adequate indicator of what exactly is the rate of growth. Secondly, when you look at those figures, there are two things which are clear. One thing which of course is I had some charts, but I don't have. But I basically let me summarize it for you. One is we know that if you take annual rates of growth, that we are talking about a period when starting from about maybe 2013-14. Of course, there was 1 year which was anyway bad, which was 2008-9, but that was because of the international financial crisis. And actually I shouldn't say international, as Jose Ocampo says, that was a North Atlantic financial crisis. If you want to call 1997 a Southeast Asian financial crisis, you should call the 2008 crisis a North Atlantic financial crisis, because neither did it start nor did it affect so much, excepting for the fallout on real economies, other countries. Okay, so we go with that and say that other than for that year, which affected in the real economy, real economic growth everywhere, we know that growth bounced back in India, and of course using the 2011-12 base statistics, but even within those statistics, we know that maybe 2014-15 onwards, there was a clear tendency, signs of a slowdown in growth in which you are not achieving the rates of growth that you were achieving earlier. In fact, some people argue that it started a little earlier. And if you take the quarterly GDP statistics, which of course are not as reliable as the annual, to the extent that the annual are reliable, you actually see that from the second quarter of 2016, we begin to see a process of deceleration, which is a deceleration which has been quite consistent. The second is, if you actually look at the so-called bounce back, because we are now the comparisons, when you make a comparison with other countries to actually say India is the fastest growing among many economies, you're really talking about the post-COVID era, well, not post-COVID completely, but let's say the post-intensive COVID era, the 2020, 2021 to a certain extent period, okay, and post that period, post those years. And if you look at it, what you actually find is that Either if you take the annual, including of course the advanced estimate provided by the government itself, whatever 6.7% or whatever it is for 2020 to 23, as is there in the economic survey, you actually find that if you compare it with the pre-COVID year, the total increase you have, in real GDP relative to the pre-COVID year points to something like a little less than a 3% rate of growth right through. So you really don't have a recovery which has occurred. And in fact, if you actually do a simple sort of extrapolation, that is, you let's say take the rates of, you take the GDP from 2011-12 going up to 1920, because it is March 2020 onwards that, I mean, let's say April 2020 onwards that the COVID effect began to be felt. And you just take the trend rate of growth for that period and extrapolate the trend rate of growth and look at the actual rate of growth, you will see that you're completely below. There's no sign of you actually moving back to a trajectory. There's no traverse back to the trajectory you would have been on, let alone being on that trajectory, but no traverse back to the trajectory you would have been on if you'd actually, were growing at the same rate as you were going in the period from 2011-12, which was the period in any case not at the highest rates of growth which we saw in the years after 2003-4. Okay, so therefore, it's not merely that there is some suspicion about these statistics, but then there's this problem that you really don't seem to have a jump back to the trajectory you were on. And finally, here again, if you actually take the quarterly statistics, there are only 3 quarters when there is even a slight excess of the quarterly GDP relative to the last quarter of 2019-20. So you really, if you look at it in terms of the quarterly, it appears as if in material terms you are below where you were in most of the quarters that follow. So you put all of this together and you say, we have a problem, here. The second thing, of course, is that you actually had a situation where if you look at the structure of the growth of this GDP, including during the, which of course all of you all know, we know that, even before the slowdown occurred, 60% starting from the early 2000s or late 1990s, 60% of the increment in GDP, or little more than 60%, was on account of services. Okay? So what does that mean? What that means is what the IIP tells us, or the ASI tells us, is true, that really we haven't seen significant manufacturing growth during the years up to 2003-4. Now, if you say that one of the failures of the Indian strategy was the inability to be able to achieve what it was thought it would achieve in the years after, around 1951, which is to become a significant manufacturing nation among less developed countries, which basically, even in terms of the objectives defined by the government, which is a very moderate objective, is that you get to 25% of GDP coming from manufacturing. All through these years, you're in the range between 17% and 20%. So you actually are not seeing any significant diversification. So if you've got anything to celebrate, what you have to celebrate is growth based on the growth of services. Now the point is, the thing about when you speak of services, there are certain services which are upfront, of course. The most important of those are software services and IT-enabled services. Of course, IT-enabled services are not even as tech as software services are. It includes everything from tech stuff like doing architectural design or engineering design online to actually picking up a telephone and telling you how to fix your computer or helping you order, a meal from somewhere or whatever it is. All of it falls within the IT-enabled services arena. So if you but even if you say that, okay, supposing, because there are these upfront services, these modern services like software services, the argument of those who are trying to hype the system was to say, why do all countries have to grow based on manufacturing? Why can't you have services-led growth? And India can be different, can actually be showing a new way. And this was actually some very serious economists, who are not even neoliberal or neoclassical in inclination, were actually pointing to this possibility that why in a world in which, being in industry requires large capital intensive investments in multiple areas, why should you actually, why should you expect every country to do that? Why can't we have growth based on services? And of course, it could be argued that if you follow the old argument of Baumol, which of course empirically we know now is not true, that services, normally the understanding of services is that since most of the services, at least in the old world, used to be one in which the service provider has to be available to provide the service at the point of delivery, that it tends to be highly labor intensive compared to other economic activities. So you can get growth and you can get employment increases. So this might be a better trajectory to follow, and that was what many people were arguing. Now the difficulty is that if we take this 62-63% increment in GDP which comes from services, or we take the services sector as a whole, which is well above 50% in terms of total GDP now, 56, 57, 58%. And we say that, okay, let's separate out modern services. Okay, and modern services, defined very, very sort of broadly. So, we can say that, of course, all of these things like business services, IT services, certain kinds of transportation services, etc. Plus, of course, educational services and health services. Much of it is provided. You can say it's modern services. Plus, public administration and defense, which of course is a larger service for the nation, but they are also services. Supposing we take all of this and look at its share in the total services sector, then only about 50% of the increment in GDP on account of services could be explained by this. So you're actually saying that, listen, if you actually start decomposing the services sector, because services are so many things. I mean, the person jumping onto a train and selling peanuts is also a service provider. So you actually find that kind of unorganized retail, certain kinds of construction services in the informal sector, etc., they account for a very large chunk, and those are very low productivity, low wage services. Now, despite that, if you take the share of output from services relative to GDP and the share of employment from services in total employment, what you actually get is that India is a country where the degree of lack of correspondence between the share in GDP and the share in employment is more than in many other countries. In fact, China has a higher share of employment in services than India has in terms of employment in services, because a lot of the modern services, or a significant chunk of the modern services, are modern services which actually trade on the basis of low wage services employment. Of course, maybe of software workers, maybe of people who can teach people how to get through competitive examinations, whatever it may be. But if you look at the revenue per worker, the revenue per worker is very high. Now, you can interpret this as being productivity, which is the way in which it would tend to get interpreted. So you can say that, oh, it's not only that services is good because it's giving us growth, but it's very productive. It's not like agriculture. So why not go to services? But what you're actually finding is that it's this kind of a thing. It's actually revenues per worker, so that you end up with a situation where this growth of a certain component of modern services can deliver for you large profits, large increases in the valuation of the stocks of companies which actually belong to that component of services, so that you're delivering billionaires every other day, including from startups and so on. But you basically are not generating any employment, and it's not a kind of thing which is doing something fundamentally structurally. Of course, software services does, but many of these other services structurally to the economy. So you can't actually say that, okay, why should we say that this hype might be coming because of the need for global finance, for dominant powers looking for legitimacy by pointing to the possibility of an underdog being, or a subordinate country being able to catch up, grow fast and catch up, etc. That is what is leading to India being identified as being this potential growth pole. But actually, what if you're not able to say it that way, possibly the way in which you try to say it is, oh, that's because of the fact that you're too obsessed with manufacturing when you point to manufacturing. Now, this this matters also because of the fact that if you take that manufacturing and see what effect it has, one effect it has, of course, is the increasing weakness on the trade front. I mean, leave out the current account front, because we get a lot of money which comes from, not merely the workers in the Gulf, but from H1B workers, etc., remittances. So there's primary and secondary income on the current account which comes in. But if you take the trade deficit, and earlier they used to say that's because of oil, but now we know that the non-oil trade deficit is a very large share of the overall trade deficit. So one problem of not having manufacturing is that same weakness, the inability to be able to generate export revenues enough to be able to adequately cover even your import revenues, without, of course, to a certain extent, the help from, as I said, these kinds of remittances, etc. Because India is the largest recipient of remittances of all countries in the world. I mean, we know that. Now, the second thing is that after what is this hype at the margin now running on? This hype at the margin is running on India doing better than China. Okay, but just look at the trade front. I mean, if you look at the trade front, India has this huge accumulation of a deficit with China. Over a period of time, despite all the hostilities, despite the fact that you get rid of a certain amount of those apps and so on because you don't TikTok or whatever it may be, we just look at it. Capital equipment, active pharmaceutical ingredient imports. So the net result is imports from China right through this period of increased sort of showdown. I mean, the standoff, etc. Imports from China keeps on increasing. Exports are falling, and exports in any case are things like iron ore, etc. They're really not of manufactured quality. So even this weakness, this inability to be able to get what you hoped you'd get in the period from 1951 to 65, that weakness is reflected in multiple ways. It's reflected in the overall trade deficit, it's reflected in your deficit with the country which you're supposed to be displacing as part of this whole integration into the global value chain. Now, I want to end with then saying, but is there nothing out here? Is there nothing out here? Because the fact of the matter is we did have in the period from 2003-4 to, let's say, 11, 12, 13 maybe, we had high rates of growth, 8% rates of growth. We did see a period in which the investment ratio in India went up to 37% or so. So there was a period. What explains that? That can't be hype, because that actually shows, even on the basis of 2004-5 GDP estimates. And when we go back and analyze that, we actually get to the core of the success of neoliberalism in India. And the core of the success of neoliberalism in India was that India actually finally was discovered by international finance as a favored destination. And that happened after 2003. Now, of course, 2003-4 was the budget in which, for the government of India under Chidambaram, it was not even an NDA government, under Chidambaram, actually decided to abolish long-term capital gains tax, which meant that if a foreign investor came and invested in India's stock market and held that investment for 366 days, because once you go beyond 1 year, that becomes a long-term investment. And whatever capital gain you get is called long-term capital gains, which used to be taxed at 20%, then was reduced to 10%, and in 2003 budget, we actually reduced it to 0%, because it was reintroduced about 3 years back. So which means you actually converted the stock market, so long as you're willing to wait for 1 year, into a tax haven. You can come, you can invest, you can make capital gains, and you don't pay any tax. And obviously that would actually attract capital to come, and when it does come, obviously that would actually, these are markets which are shallow and not too deep. There are not too many firms whose shares are actively traded, and there's not too high a proportion of those shares which is available for trading. I mean, Azim Premji and his trusts and so on and so forth possibly hold something like 70% plus of Wipro shares. I mean, we know that Adani, most of it was held by Adani or related companies. There was very little. That's why MSCI is saying, people are saying it violated the 25% rule. That you need, if you're a listed company, 25% must be available in the market. And they're saying that was not there because of the use of related companies. Now, in some sense, that provided an intense incentive. But even despite, besides that, I mean, after all, international finance is looking for favorable destinations, and India was discovered as a favorable destination, resulting in huge inflows of foreign capital, such that if you look at the cumulative inflows every year, net inflows every year, which was in excess of the current account deficit, that is, that amount of capital inflow that you needed to finance your current account, if you take the excess which came in, this was, the graph sort of goes like that. It's really a huge increase in just excess capital coming and accumulating in the country. So a large part of your so-called foreign exchange reserves are actually reflective of liabilities. They are not what you earned on the current account by exporting more than you imported. They are actually liabilities which are accumulating as foreign exchange reserves. But that does another thing. What it does is actually it infuses a huge amount of liquidity into the domestic economy. Because when somebody comes and buys a stock, let us say, or a bond, that person comes and converts dollars, euros, yens, whatever it may be, into rupees and buys it. And therefore, there is a certain degree of injection of rupees into the system, which then the person who sells it puts it into the banking system, etc. So if you look at this period, there's a huge increase in the deposit base of the banking system, as a result of which banks had to lend majorly. And when they had to lend majorly, they had to find new areas to lend. They first lend to the retail. I mean, now it's taken for granted. You don't need very much money to buy a car. You have a little bit, you go there are 10 desks, you can sit at one desk and get yourself a loan. If you want to buy, you're constantly getting telephone calls saying, listen, you want to take a loan, no documents needed, etc. You basically need aggressive lending. Now, one area into which aggressive lending went was into infrastructure. Because neoliberalism basically says that it is an important part of the state's activity to try and facilitate private investment. And one of the ways in which you facilitate private investment is by building the infrastructure needed to support private economic activity. So, what is the difference between China and India? Oh, there's so much investment in infrastructure in China because they invest something like 48% of their GDP, or used to, 48% of their GDP. So you basically needed infrastructural investment as part of a neoliberal strategy. If you wanted to get that movement from your 18% to 25% of manufacturing value added in total value added. But then on the other hand, you needed to adopt a very liberal taxation regime, and a taxation regime in which you actually wanted to provide tax concessions, including during the 2019 recession. What you do is you provide huge tax concessions, direct tax concessions to the corporate sector. Now, if you're providing tax concessions and you have a neoliberal fiscal stance, which basically says that I won't borrow and spend beyond a certain point, whatever be the figure, which can keep changing over a period of time, then you basically need to adjust your expenditures. And you of course adjust some welfare expenditures, which we keep talking about, but there is a lot of committed expenditure. There's expenditure on wage bills and pensions, on the army, on the police, and so on and so forth. So therefore, what you cut back on is capital expenditure. If you cut back on capital expenditure, how are you going to deliver on your duty to provide the private sector the infrastructural base for you to get private sector-led growth? So what you do is you say, okay, let me get the private sector to invest in infrastructure. And how do I do that? How I do that is I give it significant amount of support in the form of credit from a public banking system, which is now awash with liquidity. I will give it flexibility in pricing. I will give it access to land. I will relax environmental clearances. I will do all sorts of things to actually allow a significant degree of private interest in investment in power, in ports, in civil aviation. So you have all of these areas in which you begin to see a significant increase in investment, which drives growth. So you have growth which comes from the retail lending. Lots more people are buying cars because it's not tethered to their current income or their past savings. They can just borrow money and buy it, or buying two-wheelers, or buying houses because you can get housing loans much more easily, etc. That gives you growth. But so does you get a big growth because of the fact that there are large corporates which are being given huge chunks of loans because of the fact that you want them to go into these areas, which the banks earlier never lent to, but now started lending in very large measure. Now we know that many of these projects actually were failures. I mean, we know the big failures. We know what happened to Kingfisher. We know what happened to Jet. We know what happened. There's Karaikal Port. I mean, many areas where these private infrastructure investments didn't deliver, and therefore there was a default, which was kept below the carpet because of the fact that you went in for restructuring as part of the corporate debt restructuring cell created by liberalization. And when you restructured, you treated a stressed asset as a standard asset, till Raghuram Rajan came in 2015 and said, no, this is too much. You're just covering up all of this bad debt which is sitting on your books. Here's a new set of guidelines to recognize bad debt, and you just look at the numbers. I think from 16 lakhs to 45 lakhs or something was over a period of 3 years. Lakh crores, I'm sorry, not lakh. You saw the increase in non-performing assets. So you basically managed to get growth by riding on the bubble, which was in some sense, which is the core of India's neoliberal success. Besides the fact that it's being topped up by international finance, but the fact that it's being topped up by international finance brings the liquidity, and you rode on that liquidity. But when the crisis came, obviously you couldn't sustain that kind of a credit boom. Now, in some sense, and I'll conclude with that, in some sense, okay, we can talk about malfeasance, fraud, etc., etc. In some sense, Adani just reflects this neoliberalism. He actually got he rode on this bubble. He actually got huge amounts of loans. In order to get those loans to invest in areas which normally a new entrepreneur would not invest in, because of the fact that you're locking up a lot of your capital in 1 or 2 projects because they're very capital intensive. He didn't invest in 1 or 2 projects. He invested almost every day in a new project, or every month in a new project. That's the way he was expanding it, all substantially within infrastructure, all funded with other people's money. But note that this was not based on him going like Reliance did at one point of time, which is what you did was you did well to a certain extent in the company, and then your share price went up, you went in for a new issue which you sold at a huge premium, and because you got that share premium reserve, you could use that money to invest. So, the annual general meetings of Reliance used to happen in football fields, because you had so many shareholders. But that's not what was done here. Here you actually had control of the equity. You used multiple firms, etc., to push up the value of that equity, and you use the high value of that equity to borrow more and more, and invest it more and more in infrastructure, not just in India, but all over the world. So in some sense, what this shows is that this is not merely, being a poster child of neoliberalism is not merely that that your growth has to ride on a bubble, unless for some reason you become a successful substitute for China and the global system. But more importantly, what it illustrates is that once you start actually incentivizing the private sector, the line between incentivizing the private sector and giving it a favor becomes very thin. I mean, if I am to give a favor, why should I give it to, all and sundry? I'll give it to somebody who's, some Haryana leader supposed to have said, "Mere bete ke diyon to kya, tumhare bete ko do." So, I mean, why should I give it to somebody else? I'll give it to my family. So rather, am I going to give to my friends, my interested parties, or not going to? So there was also this whole notion that going neoliberal is actually that embracing the market introduces competition, transparency, etc. It doesn't do that. And it actually allows the realization of what is the core of a neoliberal project. And, I mean, as Stiglitz said, this is a class project. That you cannot explain what happened to income distribution in the United States between 1978 and 2008 when the crisis came, without recognizing that neoliberalism was a class project which engineered a redistribution of income and wealth in favor of the top. And that's what we are seeing happening in India as well. That's the real Indian growth story. I'm sorry I've taken longer than I thought I would.